Disclaimer: on the morning of December 26th, something out of the ordinary is set to shake the financial markets. While many of us are still recovering from holiday feasts and scrolling through post-Christmas discounts, one of the globe's most significant commodity markets will quietly enter what's known among seasoned traders as the Ghost Week, a 10-day stretch of ultra-low liquidity that could set off an 8-dot surge in silver prices. Here's why you should pay attention. Silver just wrapped up Christmas Day trading at $71.94 per ounce. That's not just high. It reflects a massive 149% increase over the past year. But the real story isn't today's price. It's what's brewing beneath the surface as institutional traders step away, leaving 145,000 open futures contracts exposed and unsupported. Picture this. You're overseeing a solar panel factory in Arizona, where operations require 50 kilos of silver daily. Your purchasing team typically secures silver months ahead through futures to avoid price swings. But what happens when the usual counterparties, the market makers, institutional desks, liquidity providers, are all gone? That's the ticking time bomb set to go off tomorrow. The silver futures market has shifted dramatically in recent months. Trading activity has surged to 145,000 contracts, creeping close to gold's average of 200,000. To put it plainly, silver, long viewed as gold's less glamorous sibling, is now soaking up nearly 75% of gold's institutional spotlight. When have we seen this before? A commodity that last peaked at $49 in 2011 is suddenly attracting high-level positioning. It forces us to ask, what does the smart money know that we don't? CME Group data confirms that open interest in silver futures has steadily risen since September 2025, with each contract representing 5,000 ounces of physical silver. Now here's where things get critical. The period from December 26th through January 5th marks the lowest liquidity window of the entire year. Investment banks shut down desks. Hedge fund managers retreat to ski resorts. The market makers responsible for maintaining stable price spreads, they're gone. During this Ghost Week, trading volume can plummet by 70% or more, yet those 145,000 futures contracts remain live. We got a taste of what's coming just last week. Silver reached a record-breaking 72.70 on December 23rd, only to ease slightly and close Christmas Day at $71.94. UBS analysts called the late December rally unhinged, pointing to year-end positioning and thin liquidity. When UBS, one of the most prominent commodity trading institutions in the world, uses the term unhinged, it's not exaggeration, it's a red flag. Meanwhile, analysts at Kitco Metals see the next technical target at 75 studcents per ounce before year-end. From where we are now, roughly $70, that's just a $3 move, which could happen rapidly in an illiquid market. Silver's dramatic rise in open interest is no coincidence. For the first time in recent memory, silver contracts are closing in on gold's level of institutional engagement. That shift alone suggests something deeper is happening beneath the surface. Let's rewind to 2011, when silver last touched $49 per ounce. Back then, the spike was driven largely by retail speculation. This time, the volume and structure of institutional positioning imply a more serious, long-term strategy is in motion, according to CME Group figures. Open interest in silver futures has climbed steadily since September 2025. Every single contract represents 5,000 ounces of physical silver, and they're piling up fast. What makes this moment even more sensitive is timing. The stretch between December 26th and January 5th is notoriously illiquid. Big banks have shuttered their trading floors. Fund managers are vacationing. The usual players who provide bid-ask stability, out of office. During this holiday blackout, daily trading activity can collapse by over 70%. Yet the 145,000 contracts, they remain active and unresolved. It's like watching a massive traffic jam form with no one at the control tower. Last week gave us a taste of what's coming. On December 23rd, silver spiked to an all-time high of $72.70 before slightly retracting to $71.94 on Christmas Day. UBS analysts didn't hold back, calling the move unhinged, a sign that thin liquidity and calendar-based position shifts are shaking the market structure. Let's be clear, when UBS and one of the world's top players in commodity markets call something unhinged, it's not poetic, it's a signal that danger is real. Meanwhile, Kitco analysts are targeting 75 $75 per ounce as the next short-term resistance from the current $70 level. That's a $3 move that could happen in a blink under these conditions. Under normal conditions, a $3 move in silver might unfold over several weeks or even months. as prices adjust gradually through typical market dynamics. But in a market where liquidity has evaporated and futures obligations are piling up like planes circling an airport, that same $3 movement could play out within mere hours. Here's the part most people overlook. The March 2026 silver futures contracts, ticker symbol SIH26, became the leading vehicle for trading on November 22nd, 2025. That date marked a critical shift when billions in financial commitments rolled forward into a contract that matures in less than 90 days. Every industrial company needing physical silver for February or March production, every investor intending to take delivery, and every speculator betting that silver prices would stay low, they're now all concentrated in the same narrow contract window. And this window collides head-on with the worst liquidity stretch of the entire year. Just look at the chain reaction. Markets shut on December 25th for Christmas. Boxing Day, December 26th, sees key financial hubs like London, Hong Kong, and Singapore all closed. Then the weekend arrives. December 30th and 31st operate with reduced staffing as year-end celebrations slow activity to a crawl. January 1st, 2026 marks another global holiday closure. That means we may not see anything resembling normal trading conditions until January 2nd, or more realistically, January 5th. In total, it's 10 days of frozen price discovery. While real-world demand from manufacturers continues uninterrupted, and while pressure inside those March 2026 contracts builds relentlessly, analysts at FX Leaders have echoed what seasoned traders already understand during this holiday freeze. Even small bursts of buying activity can spark outsized price jumps. With no one on the other side of the trade, because sellers are off their desks, prices can only go one way. We've seen this movie before. In January 2015, the Swiss franc spiked 30% in minutes after the Swiss National Bank unexpectedly removed its euro peg, right in the middle of low-volume trading. Or think of the British pound flash crash in October 2016, when the currency plunged 6% in seconds during Asian hours, with Western markets offline. Silver is now heading toward a similar vacuum, but this time, it's not a surprise move. It's a calendar-driven collision everyone sees coming, but few seem prepared to manage. And that's exactly what makes this setup especially risky for those holding short positions or unhedged exposure. At $72 per ounce, silver is already trading at historically high levels. The previous peak in 2011 was $49, meaning we're now hovering almost 50% above that prior record. Normally, such a premium would suggest that silver is overvalued and could face a pullback. But expensive is a relative term, and in this case, it's all about supply and demand, not past price points. When markets reopen in early January, industrial buyers who postponed purchases during the holiday shutdown will be left with only two options. Either pay whatever elevated price the market presents, or risk missing critical deliveries needed for February and March production. There's no middle ground. You can't build solar panels without silver. You can't stall electrical systems in car manufacturing. You can't tell clients, we'll ship later when prices come down. The system is under pressure, and as December 26th arrives, we enter Ghost Week, a stretch where market liquidity, the only safety valve, vanishes. This isn't a prediction, it's a real-time observation. Those 145,000 futures contracts are active. The liquidity drought is baked into the calendar. The obligations tied to March 2026 contracts are locked in. The only uncertainty left is how violent price discovery will be once all these forces meet in early January. For those of us watching from the sidelines, this situation brings both risk and insight. The risk is clear. If you're short silver or relying on stable prices for operational planning, prepare to see what happens when mathematical certainty collides with market mechanics. But the revelation is deeper. We're witnessing the moment where the paper market crashes into physical reality, when futures contracts must turn into real metal, when speculation meets the hard limits of physical supply. Ghost Week starts tomorrow, and the squeeze is already in motion. The $8 price gap people will be discussing in January, it's being built right now, one thinning order book at a time, during a period when most assume the market is asleep. But it's not closed, just empty. And in finance, empty doesn't stay empty for long. It gets violently filled when liquidity comes rushing back and reveals that prices were misjudged all along. Now, let's break down why these 145,000 contracts are far from theoretical. They represent real metal that real businesses absolutely need to maintain production. Industrial demand for silver hit an all-time high of 680.5 million ounces in 2024. That figure isn't a mistake, and it's not just a minor increase. According to the Silver Institute's World Silver Survey, This is the largest level of industrial consumption ever recorded in the silver market's history. For context, global mining output across all countries totaled just 813 million ounces in 2024. Do the math, we mined 813 million. But the industrial sector alone consumed 680.5 million, leaving only 132.5 million ounces to meet all other demands, including jewelry, coins, investment, medical use, and strategic government stockpiles, especially now that silver has been classified as a critical mineral in the US. But this is where the numbers get truly concerning. Industrial demand for silver isn't a fixed figure we can rely on. It's rapidly accelerating, driven by a technological shift that few saw coming even 5 years ago. In 2024 alone, the solar photovoltaic industry consumed more than 200 million ounces of silver. That represents over 30% of total industrial demand going into just one application. Let that sink in. A single industry, solar panels, is now using nearly a third of all the silver mined globally each year. And the outlook is getting even more intense. The solar sector has transitioned to a new standard called TOPCon technology, short for tunnel oxide passivated contact. For the silver market, here's what matters. TOPCon panels use 50% more silver than the older PEER technology. Not 5%, not 10%, a staggering 50% increase per panel. Estimates from the International Energy Agency and several solar market analysts suggest that by 2030, the solar industry alone will require between 10,000 and 14,000 metric tons of silver each year, converted into ounces. The high end of that forecast, 14,000 tons, equals roughly 450 million ounces from solar panels alone. Let's put that in perspective. Total global silver production in 2024 was around 813 million ounces. If solar alone consumes 450 million, and all other industrial uses remain unchanged, then total demand would exceed 900 million ounces, more than 100% of global mining supply, before we even consider jewelry, coins, or investment demand. And even with silver priced at $72 per ounce, there's little incentive for copper miners to increase output since silver is mostly produced as a byproduct. The Silver Institute confirms this. Over the past 10 years, silver mining production has grown less than 1% annually, while industrial demand has jumped 15% and is expected to rise further through 2030. This leads to a harsh realization. We're sitting on a time bomb. The silver market has now posted deficits for 7 straight years. That means no surplus, no equilibrium, just pure overconsumption. In 2024 alone, the shortfall hit 148.9 million ounces. That's close to 20% of yearly mine output, simply disappearing from available supply. But the bigger picture is even more alarming. Add the cumulative deficits from 2021 to 2024, and you get a total of roughly 678 million ounces, equivalent to about 10 months of global mining. Almost an entire year's production has been drawn from inventories. Where did that silver come from? From ETF reserves, government stockpiles, and recycled silver. But here's the question nobody in mainstream finance is asking. How long can we keep draining reserves before there's nothing left? When demand outpaces supply year after year, stored silver becomes the hidden source, but that source isn't infinite. But inventories are not endless. Sooner or later, the drawdown reaches a point where there's simply nothing left to pull from. Data from the CPM Group and the Silver Institute shows that identifiable above-ground silver inventories have been steadily declining. In fact, silver-backed exchange-traded products absorbed 95 million ounces in the first half of 2025 alone. That's pure investment demand. Investors buying silver as a store of value, competing head-to-head with industrial users for the same limited supply. Consider how this plays out in the real world. A solar panel manufacturer in California needs silver to keep production running. An investor in New York wants silver as protection against inflation. An automotive company in Michigan requires silver for vehicle electronics. All of them are fighting over metal coming from the same 813 million ounces of annual global supply, and that supply has barely increased in 8 years, while demand has risen at double-digit rates. Economic theory is clear on what happens next. Prices rise until demand is destroyed or new supply emerges. But we've already seen why new supply can't appear quickly. Silver is mostly produced as a byproduct of other mining operations. That means the entire burden of restoring balance falls on higher prices, forcing demand reduction. The critical question is, how high do prices need to go before industrial demand actually breaks? Can solar manufacturers simply stop using silver and switch to cheaper materials? Technically, no. Not without redesigning panel structures entirely, a process that takes years and billions in research and development. Can automakers remove silver from electrical systems? Not when silver remains the most electrically conductive metal available at scale. And vehicles demand increasingly complex electronics for safety, battery systems, and autonomous driving. Can medical device producers abandon silver in antimicrobial applications? Again, no. Silver's properties are essential and irreplaceable in certain health-critical uses. The hard truth is that industrial silver demand is highly inelastic. Even when prices rise sharply, demand barely falls. A solar company may complain about paying $72 per ounce instead of $25, but if silver is required to deliver panel contracts worth millions, they'll absorb the cost. Even at $17, silver remains a small portion of total manufacturing expenses. This inelastic demand is exactly what fuels explosive price moves during liquidity crunches, when buyers cannot postpone purchases due to fixed production schedules, and sellers disappear because liquidity dries up. The market loses its ability to discover prices gradually. Instead, prices gap violently, suddenly, and irreversibly. We saw early signs of this dynamic in late December. UBS strategists did not use the word unhinged lightly. They were observing price movements that had broken away from standard supply-demand behavior, driven instead by positioning pressures and liquidity constraints. Analysis from FX leaders confirmed the mechanism. When global markets are closed and real volume disappears, even small buying pressure can trigger disproportionately large price swings. Now picture this scenario playing out in the first week of January, where months of delayed buying pressure collide with the reopening of the silver futures market. The result is a setup so volatile it could make the Swiss franc shock appear controlled by comparison. What amplifies this risk is a fundamental flaw in institutional positioning under regular market conditions. When liquidity is strong, large institutional traders have the tools to manage risk. They can scale positions, roll contracts, or fine-tune exposure. They have flexibility, time, and most importantly, counterparties willing to engage. But during the ghost week, those tools vanish. If you're short on March 2026 silver futures and want to exit, who's going to take the other side of your trade when market makers are off the grid? If you're a commercial participant trying to shift your exposure from March to May contracts, where do you find the liquidity to do so without enormous price impact? The simple answer is YR can't. That liquidity disappears during this 10-day vacuum. Institutions are left in a binary situation. Either they entered their positions before the market froze and they have no choice but to hold, or they will have to pay whatever the market demands once trading resumes. Judging by the record-breaking 145,000 open contracts heading into the holidays, it's clear many opted to lock in early and ride it out. That's billions in notional value suspended in a market operating in slow motion. Now consider the dilemma through the eyes of a corporate hedging manager. Suppose you're the procurement director at a major electronics company. Your factory consumes 500,000 ounces of silver monthly, back in November. You prudently secured February and March supply by locking in futures at $30 to $32 per ounce. It felt expensive then, but it was a smart risk move. Fast forward to December 26th, silver now sits at $72 per ounce. Your hedges are deep in the money, delivering paper profits worth millions. But there's a catch: the market is illiquid, and you ain't captured those gains. Even worse, you're watching silver prices continue to rise, and you're completely unable to respond. If market conditions were normal, you could sell those contracts and re-enter at current prices, locking in your profit, but the structure won't let you do that. Now imagine this same problem playing out across dozens of manufacturing companies, hundreds of institutional trading desks, and thousands of individual futures positions. This is why the March 2026 contract has turned into a high-pressure vessel. Everyone is trapped, no one can adjust, and the only mechanism that can ease this pressure, market liquidity, won't return until at least January the 2nd. The 7-year deficit we mentioned earlier is not distant history. It's the bedrock underneath today's price action. Every single ounce of that 678 million ounce cumulative shortfall had to come from somewhere. It was pulled from ETF liquidations, melted jewelry and coins, government stockpile releases, and the steady depletion of commercial inventories. Data from the World Silver Survey shows a troubling trend: identifiable silver inventories across exchanges, ETFs, and depositories have continued to fall even as prices have climbed. That directly contradicts traditional economic theory. Rising prices are supposed to draw supply back into the market, yet that isn't happening here, because the supply simply does not exist to be sold, regardless of price. Once inventory drawdowns can no longer bridge the gap between production and consumption, the market loses the ability to rebalance gradually. At that point, price doesn't adjust smoothly, it snaps violently. price discovery becomes abrupt and destructive, forcing immediate demand reduction rather than encouraging slow adaptation. The looming test now is whether $72 silver is high enough to eliminate enough industrial demand to restore balance. Based on the data, the answer appears to be no. Solar installations are not slowing. They are accelerating worldwide due to climate policy mandates and government subsidies. Automotive electrical systems are not simplifying. They are becoming more complex with every new generation of vehicles. Medical usage is not declining either. It is expanding as populations age and healthcare technologies advance. If $72 fails to meaningfully curb demand, and mine output cannot rise on any practical timeline, then the question becomes unavoidable. Where does the market actually clear? At $80, at $100, or at a level we've never witnessed before, simply because industrial silver consumption has never operated at this scale in history? That is the calculation waiting to be made when liquidity returns in January. With 145,000 futures contracts concentrated in the March 2026 delivery window, representing buyers who need physical metal and traders who misjudge direction. The outcome isn't theoretical, it's mathematically inevitable. This is a calendar-driven liquidity crisis, layered on top of 7 years of structural deficits and amplified by record industrial demand that cannot easily be reduced, all colliding during the weakest liquidity window of the year. The Ghost Week didn't create this crisis. It merely stripped away the disguise that had been hiding just how severe the supply-demand imbalance already was. Now let's look at the math everyone will be discussing in 2 weeks, when positioning for it is already too late. We begin from a $72 base price, established on Christmas Day 2025. Analysts at Kitco Metals have identified $75 per ounce as a clear technical resistance level before year-end. That represents a $300 move, or roughly a 4.2% gain from current levels. Under normal market conditions with healthy liquidity, a 4.2% move might take weeks or even months to unfold, as buyers and sellers negotiate price through countless small trades. These are not normal conditions, but these are far from normal market conditions, and $75 is not the destination, it's merely the first technical milestone. The next meaningful resistance level sits at $80 per ounce, supported by technical chart patterns and the psychological weight that round numbers consistently carry in commodity markets. Starting from the $70 baseline, a move to $80 represents an $8 advance, equivalent to an 11.1% gain. Does that still sound small? Let's put that 11.1% into context. Each silver futures contract controls 5,000 ounces, and with 145,000 contracts outstanding, that equals 725 million ounces of notional exposure. At $72 per ounce, total notional value comes in at $52.2 billion. A move up to $80 pushes that figure to roughly $58 billion, creating an increase of about $5.8 billion in total position value. Here's the part most people overlook. That $5.8 billion doesn't remain a theoretical gain or loss on paper. In futures markets, daily price changes trigger margin calls, requiring real cash to be posted by the next trading session. When silver jumps $8 in days or even hours, every short seller. Every commercial hedger positioned incorrectly and every trader betting on mean reversion faces immediate margin demands totaling billions. So what happens when those margin calls hit in the first week of January? Just as liquidity begins to reappear but remains thin, forced liquidation. Traders unable to meet margin requirements must exit positions at market prices, no matter how unfavorable. In a thin market, this forced buying creates a self-reinforcing cycle. Buying drives prices higher. Higher prices trigger more margin calls, and those calls force even more buying. This is the squeeze mechanism in its purest form. There's nothing manipulative about it. There's no conspiracy involved. It's simply mathematics colliding with market structure under conditions of severe liquidity stress. Positioning data from the CFTC Commitments of Traders reports shows that managed money, including hedge funds and large speculators, hold significant long positions in silver futures. At the same time, the commercial category, composed of mining firms, industrial users, and banks offering hedging services, carries substantial short exposure. Those short positions were entirely rational when they were established. A miner expecting to produce 1 million ounces over the next 6 months naturally sells futures to lock in revenue. An industrial buyer holding silver inventory shorts futures to hedge against price drops. Banks offset client exposure by taking the opposite side of trades. All of this is perfectly sound risk management in a normal market, but when liquidity disappears at historically elevated prices, With record open interest locked in place, those once safe hedges transform into potential multi-billion-dollar liabilities. Consider the timeline ahead. Starting December 26th, market liquidity all but vanishes. December 27th and 29th fall into a weekend stretch with barely any trading activity. December 30th and 31st see skeleton crews managing end-of-year accounting with minimal volume. January 1st marks a global holiday with every major financial market shut, although January 2nd technically marks the reopening. In reality, true liquidity won't return until January 5th or 6th, when most institutional traders are finally back at their desks. That gives us 10 consecutive days where price discovery is largely paralysed. Yet, industrial demand doesn't pause. Manufacturing plants producing solar panels in countries like China, India, and the United States keep operating through the holidays. Auto assembly lines don't shut down. The electronics industry doesn't take a Christmas break. In fact, industry reports suggest many factories ramp up output during the last week of December and early January to meet quarterly goals and ship backlogged orders before the fiscal year closes. These manufacturers require actual silver to be delivered on time, and their deadlines are indifferent to financial market holidays. So, when these industrial buyers return to the futures markets on January 2nd or 3rd, seeking to purchase contracts they postponed during the thin liquidity window, what price will they face? The only answer, whatever the market demands, because no alternative exists for immediate sourcing. Physical silver doesn't magically appear. It must be extracted from the ground, processed, transported, and scheduled for delivery. A chain that unfolds over weeks, not hours. The March 2026 silver futures contract became the main front-month instrument back on November 22nd, 2025, meaning every fresh position, rollover from December contracts, and hedging transaction is now flowing into March delivery. But from the start of January, March is just 2 months away. That might sound like plenty of time, until you factor in the real-world logistics of taking delivery. A buyer seeking physical settlement must notify intent, secure vault access or delivery routes, coordinate with the refineries, and arrange fund transfers. These actions demand advanced lead times. The CME Group mandates that notice of intent to deliver or receive metal be filed well before the contract matures. The closer we move toward March, the tighter that operational window becomes. Industrial users who truly need silver can't afford to wait. If they delay, they risk falling out of the delivery queue. That creates a binary choice: lock in March contracts in early January at whatever price, or risk missing vital production runs. Silver isn't something you can substitute with IOUs. You either have it on the production floor, or you don't. And here's where the story escalates from commodity dynamics to strategic national policy. In 2025, silver was officially classified as a critical mineral in the United States. That designation is more than symbolic. This designation is not symbolic. It is a formal acknowledgement that silver is critical to economic stability and national security, with supply chains that are increasingly fragile. Data from the US Geological Survey shows that once a material is classified as a critical mineral, it activates concrete policy responses, including expedited permitting for domestic mining projects, consideration for strategic stockpiles, trade protections, and closer government oversight of supply risks. While there is no public disclosure on how much silver governments may be stockpiling, the simple fact that state procurement could step into the market as an additional buyer adds significant strain to an already tight supply-demand equation. In practical terms, critical mineral status means the US government is openly recognizing the strategic importance of securing silver supply. Silver underpins solar panels for the energy transition. It is essential for defense electronics and military systems. Medical equipment relies on it, telecommunications infrastructure, including 5G networks, depends on it. Once a commodity reaches this level of strategic importance, price becomes secondary to availability. If government agencies determine that domestic inventories must be expanded for security reasons, they will buy silver at prevailing market prices, whether that price is $72, $80, or even $100. Strategic necessity outweighs cost considerations. This introduces yet another layer of highly inelastic demand on top of the industrial demand already in place. And it's important to remember that global silver mining produces only 800 to 913 million ounces per year, a figure that has not meaningfully increased since 2016 despite a dramatic rise in prices. Here is the supply-side reality no policy or market force can shortcut. You cannot rapidly increase silver production, even if silver trades at $100 per ounce and mining becomes extremely profitable. Bringing a new mine into production is a multi-year process. It requires geological exploration, environmental approvals, infrastructure development, equipment acquisition, workforce training, and processing facilities. According to S&P Global Market Intelligence, the average greenfield mining project takes 6.5 years from final investment decision to first production, and that assumes a discovered deposit, completed feasibility work, and secured permits. In many cases, those prerequisites alone take several additional years. So if silver prices surge in January 2026, when does new supply actually arrive to relieve pressure? Not in 2026 or 2027, not in 2028, and possibly not until 2031 or 2032 if projects are only beginning today. That timeline also assumes prices remain elevated long enough to justify billions in capital investment, and that projects avoid regulatory delays, environmental challenges, or opposition from local communities. This is why the annual 148.9 million ounce supply-demand gap cannot be solved through increased production in any meaningful timeframe. The market has only one way to rebalance. Prices must rise until demand is curtailed or substitutions occur. But as established earlier, industrial silver demand is exceptionally resistant to price pressure. Solar manufacturers are locked into technology roadmaps set years ago. With billions already committed to TopCon production facilities, they cannot simply switch to silver-free designs. That technology does not exist at commercial scale. At that point, manufacturers face a simple reality. Either they pay higher silver prices or they shut down production. And shutting down doesn't just pause operations. It means breaching customer contracts that are worth far more than the added cost of silver. Automotive manufacturers face the same dilemma. Modern vehicles rely on highly complex electrical architectures that depend on silver's unmatched conductivity. Eliminating silver from those systems isn't a realistic option. Redesigning vehicle electronics would require years of engineering effort and billions of dollars in retooling. In practice, it's far cheaper to pay $80 or even $100 per ounce for silver than to redesign entire vehicle platforms. That's what creates the mathematical certainty behind the squeeze. When supply is fixed, demand is inelastic, and inventories have been drained over 7 straight years of deficits. Price becomes the only remaining variable. And when a market hits a liquidity crisis during the weakest trading window of the year, price doesn't move gradually, it jumps abruptly to whatever level is necessary to restore short-term balance. Now consider a worst-case scenario that grows more plausible as the data piles up. Markets reopen on January 2nd after a 10-day liquidity blackout. Industrial buyers who postponed purchases during the holidays rush back in to secure March 2026 contracts for spring production. Hedge funds and managed money players who rode the move from $30 to $72 see the momentum intact and add to long positions. At the same time, commercial shorts who were comfortable when prices were $60 or $65 suddenly begin facing margin calls as silver pushes towards $75. Some can meet those calls. Others, especially smaller firms or leveraged participants, cannot. They're forced to buy back short positions at market prices. That buying pressure drives silver through $75. Once that level breaks, chart-focused traders recognize a technical breakout. Momentum-driven algorithms activate and layer on even more buying. Prices jump to $77, then $78. Commercial shorts still hanging on are hit with escalating margin demands, triggering further forced buying. Eventually, $80 breaks. At that moment, silver has moved $8 from its Christmas Day close near $70, the exact squeeze scenario being discussed from the start. But here's the uncomfortable question. Why would it stop at $80 if the underlying supply-demand imbalance remains unresolved? If industrial buyers still need metal, inventories stay depleted, and mine production hasn't suddenly increased, what mechanism halts the move? In a short squeeze, prices don't stop at tidy resistance levels. They stop when shorts are completely liquidated or when new supply enters the market, whichever happens first. And we already know new mine supply won't arrive for years. That means prices can keep running until shorts fully capitulate, or until industrial buyers begin cancelling orders because silver becomes prohibitively expensive. The real resistance levels aren't technical lines on a chart, they're economic pain thresholds. At what silver price does a solar manufacturer walk away from billion-dollar panel contracts? At what level does an automaker delay the launch of new vehicle models? That's where demand finally starts to crack. No one knows precisely where those breaking points lie, because they've never been tested under supply and demand conditions like these. The silver spike to $49 in 2011 unfolded in a very different environment. That move was largely driven by speculative investment flows. This time, the pressure is coming from industrial demand colliding with deep structural supply deficits, or while the market is passing through a severe liquidity crunch. History shows us exactly how industrial commodities behave when these forces converge. Between 2016 and 2020, palladium surged from roughly $500 to $3,000 per ounce as automotive demand for catalytic converters overwhelmed available mine supply. In 2022, lithium carbonate exploded from about $6,000 to $80,000 per ton once battery demand outpaced production capacity. In neither case did prices rise smoothly. They accelerated violently through multi-month rallies that caught most participants completely unprepared. Silver now appears poised for a similar outcome, except the timeline is far more compressed. The ongoing liquidity crisis shortens the runway, rather than a move unfolding over quarters or years. The entire ADIT+ advance could occur in a matter of days or weeks. Here's what anyone watching this situation needs to grasp. The liquidity blackout begins December 26th. By the time you're reading this, if Christmas has already passed, the trap has likely already closed. The market has entered Ghost Week. Roughly 145,000 contracts, representing 725 million ounces and about $52 billion in notional value, are effectively frozen in place. When markets reopen on January 2nd or 3rd, the opening price could look nothing like the $72 close on Christmas Day. Futures markets are permitted to gap. There is no obligation for continuous price discovery. If enough buy orders stack up during the closure, the market can simply reopen $5, $8, or even $10 higher without a single trade in between. For those holding long exposure to silver, whether through futures, mining equities, or physical metal, this is the scenario they've been positioning for. The setup is unusually clean. Tight structural fundamentals colliding with a predictable liquidity shock at record price levels and unprecedented open interest. For anyone short silver or operating without adequate hedges, the next 2 weeks represent an existential threat. Positions cannot be adjusted during Ghost Week. Margin cannot be posted if brokers call. Losing trades cannot be exited in an orderly way. Once liquidity disappears, participants are locked in, and when it returns, they must accept whatever price the market dictates. For industrial users who depend on physical silver to keep production running, this is the moment for brutal self-assessment. If your plan relies on purchasing silver in the spot market in January or February to meet spring production requirements, you are effectively wagering that this analysis is wrong. You are assuming that supply-demand imbalances will magically resolve, that liquidity will return smoothly, and that prices will stay stable, despite overwhelming evidence to the contrary. That isn't a hedge, it's hope. Hedge. And hope is not a strategy when you're dealing with mathematical certainty. The $8 silver squeeze isn't a guess about what might happen if everything lines up just right. It's an observation of what happens when specific. Measurable forces collide. 7 years of structural supply deficits. Record industrial demand that cannot be meaningfully reduced. 145,000 futures contracts locked into a narrow delivery window. Silver's critical mineral designation, adding strategic demand, and the worst liquidity conditions of the entire calendar year. The math is straightforward. The structure is clear. The catalyst is guaranteed by the calendar. And the result, when billions of dollars in forced buying collide with thin liquidity and tight physical supply, has only one possible direction of resolution. Ghost Week begins tomorrow. The squeeze is already set in motion. And when markets reopen in January, and the question becomes, how did silver gap from $72 to $80 overnight? The answer will be obvious to anyone who followed the numbers. Because when liquidity disappears but contractual obligations remain, price doesn't negotiate, it doesn't pause, it doesn't smooth itself out. Price simply jumps to whatever level is required to clear the imbalance. And with 145,000 open contracts, a 148.9 million ounce annual deficit, and 10 full days of frozen price discovery, that clearing level is almost certainly far above $72. The only question left isn't what will happen. It's whether you're positioned for what's mathematically inevitable, or whether you're still hoping the math somehow doesn't apply this time. By January 2nd, we'll all know the answer.